Hey there, I'm Bev from bookkeepingcoach.net. With over 30 years in bookkeeping and finance, I've seen it all and fixed it all. Whether you're a new bookkeeper or a business owner handling your own books, I know how overwhelming it can get when there's no one to turn to with questions. That's exactly why I created this channel. No more messy books, no more sleepless nights. Just clear, practical advice from someone who's been in the trenches. So hit the subscribe button and let's transform those financial headaches into financial clarity, one entry at a time. Bookkeepingcoach.net. Your questions answered, your business empowered. Welcome back to our QuickBooks Online tutorial series. Today, we're tackling product and service setup, which is one of the most confusing aspects of QuickBooks Online for many users. Getting this right is absolutely essential for accurate sales and inventory tracking. Did you know that incorrect item setup is the primary cause of most inventory nightmares? Today, I'll explain the crucial differences between product types and how they affect your financial reports. You'll also discover time-saving techniques for managing complex product catalogs effectively. Products versus services. Let's start with the key differences in how QuickBooks Online handles products versus services. Products are tangible items that can be counted, potentially inventoried, and have associated costs. Services represent work performed, cannot be inventoried, and involve time or expertise. This fundamental distinction affects how transactions flow through your financial statements. Products can affect both your income statement and your balance sheet, while services only impact the income statement. Products allow quantity tracking, even without inventory, while services may use quantity for hours or units, but don't maintain ongoing counts. Your classification choice determines which fields are available and how transactions affect your financial statements. Choosing incorrectly creates ongoing bookkeeping challenges that can be difficult to try and correct later on. When mapping products and services to accounts, products typically need an income account for sales. If inventory is tracked, they also need inventory asset and cost of goods sold accounts. Services usually only need an income account. Your account selection determines where your transactions appear on your financial statements. So create specific income accounts for major product lines or service categories. For example, a landscaping company might have separate accounts for design services, maintenance services, and plant materials. Always verify the account mapping before saving new items, as correcting misposted transactions later is extremely time-consuming. The income and expense tracking approaches differ significantly between service and product businesses. For services, revenue is recognized when performed or invoiced, and direct costs are recorded separately. Non-inventory products work similarly to services. Sales go to revenue, and costs are tracked separately. Inventory products use a perpetual inventory system, where costs automatically move from your inventory asset account to cost of goods sold when those items are sold. This affects gross margin reporting and your balance sheet. Transitioning from services to inventory tracking changes both your workflow and your financial statements. Service expense tracking often requires classes or tags for proper allocation, while inventory products have built-in cost tracking. For service-based businesses, create service items aligned with your pricing and delivery model. Set up hourly services with hour as the unit and your standard rate. For flat rate services, create items for each service package. Use consistent naming for recurring services and leverage project tracking features for time and expenses against specific projects or clients. This will allow you to generate profitability reports by service type, staff member, or client. Consider whether tracking billable versus non-billable time is important for your business model. Inventory versus non-inventory items. Understanding the impact on your balance sheet is crucial when deciding between inventory and non-inventory tracking. Inventory tracking creates an inventory asset account on your balance sheet, making unsold inventory a business asset. When sold, the value transfers from your balance sheet to your income statement as cost of goods sold. Non-inventory items have no balance sheet impact. Purchases are immediately expensed. This distinction matters for financial reporting accuracy and tax purposes. Significant inventory tracked as non-inventory items understates your assets and overstates your expenses. Conversely, tracking low-value consumables as inventory creates unnecessary complexity. As a general rule, items purchased for resale with material value should be tracked as inventory. When deciding whether an item should be inventory tracked, consider its material value. Items with significant individual value, say over $100, or high aggregate value, are good candidates for inventory tracking. Consider shelf life. Items for extended periods before selling should typically be inventoried. Volume and turnover also matter. High volume items with quick turnover might work as non-inventory if their value remains consistent. Your reporting needs are another factor. Precise margin data by product requires inventory tracking. Remember that inventory tracking requires discipline in recording all movements. For example, a construction company might inventory major appliances, but not fasteners. A service business with occasional product sales might use non-inventory tracking if volumes are low. Cost of goods sold tracking differs significantly between inventory and non-inventory items. For inventory items, QuickBooks automatically calculates and posts COGS entries when an item is sold, using the average cost method based on purchase history. This ensures costs match with the corresponding sales in the same period and provides accurate gross margin reporting. Non-inventory items generate no automatic COGS entry. You must manually track expenses, often through a separate expense account. This can lead to timing mismatches between sales and related costs. Inventory tracking changes your workflow. You must record inventory receipts when items arrive, not just when paid for. It also requires consistent inventory count procedures to correct discrepancies. When handling items that transition between types, for example, from non-inventory to inventory, follow these steps. Conduct a physical count to determine quantities and values. Create a new inventory item. Make an inventory adjustment using adjust quantity value on hand. Debit your inventory asset account, and credit an equity or adjustment account. Consult your accountant about the appropriate offset account for your business. For the reverse transition, inventory to non-inventory, zero out the inventory value using an adjustment, create the inventory asset and debit an adjustment account, then create a new non-inventory item. Consider timing these transitions at the beginning of a fiscal year or quarter and document the process thoroughly. Keep in mind that these changes have tax implications your accountant needs to know about. Setting up bundles and price levels. Creating product or service bundles that track properly requires the bundle feature in QuickBooks Online. QuickBooks Plus or Advanced offer this. Access this through Products and Services, New, Bundle. Add component items and quantities as needed. Follow these best practices. Create and map all component items first. Decide whether to show components on customer forms. Understand that bundles don't maintain their own inventory. Components are tracked instead. You can set pricing by automatic calculation from components or use a custom price. Remember that selling a bundle reduces inventory of each component, so accurate component quantities are absolutely essential. Setting up tiered pricing and bulk discounts provides flexibility. For tiered pricing by customer type, Go to the gear icon, Custom Form Styles, Customize, and Price Rules. Create price levels such as retail, wholesale, and distributor, and then assign these in the customer profiles. For volume-based discounts, use the gear icon, List, Price Rules. Set up rules for quantity thresholds. For example, 5% for 10 to 24 units, 10%, 25 to 99 units, and 15% for 100 plus units. QuickBooks automatically applies these discounts based on the quantity entered. For customer-specific pricing, edit the product or service and add customer-specific pricing. Test your configuration with sample transactions, and remember that multiple rules can apply simultaneously. Managing component inventory in bundled products requires careful attention. QuickBooks reduces inventory of each component when a bundle is sold, so you must maintain accurate inventory of all components. Create a custom bundle components inventory report and run it weekly to identify potential component shortages. Consider using purchase orders for components based on projected bundle sales and account for both individual and bundle demand when reordering. Keep in mind that bundles don't appear on inventory valuation reports. Only the components do. When composition changes, create new bundle items rather than modifying the existing ones to maintain your historical accuracy. For price level strategies with different customer types, first define your customer segments: retail, wholesale, distributor, or perhaps bronze, silver, gold. Determine the appropriate pricing or discount percentages for each segment. Create price rules through the gear icon, Lists, Price Rules, creating a rule for each customer type using either percentage discounts or fixed custom prices. Assign these price levels in customer profiles. You can create product-specific rules for different discount structures. Consider whether discounts should appear visibly on invoices or as a separate line item. Test your configuration thoroughly before rollout and train your team on when to override automatic pricing. Balance profitability with competitive positioning when setting these different levels. Managing product attributes and SKUs. Creating a logical SKU system that scales with your business is invaluable. Define a consistent format incorporating key product attributes. I recommend using a format that includes department or category, plus subcategory, plus item identifier, plus variation codes. For example, men, shirt, button-down L blue for men's large button-down blue shirt. Keep the SKU to around 8 to 10 characters for readability, and avoid ambiguous characters like 0 and O or I and 1 that can be confused. Never incorporate pricing into SKUs as the prices change, and leave gaps in numbering sequences for future products. Enter SKUs in the SKU field on the name field and ensure uniqueness across all products. A well-designed SKU system pays dividends in reducing errors, faster processing, and easier management. Custom fields add flexibility for product variations. Access them via the gear icon. Create fields for relevant variations such as size, color, material, weight, dimensions, locations. These fields serve multiple purposes. They appear on sales forms to communicate specifications, facilitate detailed product filtering when processing orders, and they enable sophisticated inventory management and reporting. Use custom fields with your SKU system rather than creating separate items for each variation. This keeps your product list manageable while also maintaining detailed tracking. Establish standardized values for consistent entry. Always use blue, not blue BLU. Managing product categories improves reporting. Design a category structure aligned with business decision making. Common approaches include categorizing by department, product line, vendor, margin level. Implement categories via the Categories feature for products and services. Access this through the gear icon, Products and Services, Categories tab. Create a hierarchy with parent categories and subcategories, and assign the appropriate category when creating or editing products. You can filter inventory sales and purchasing reports by category to reveal insights on profitability and inventory turnover. Export category filtered reports to Excel for deeper analysis. Effective categorization requires team training and periodic review for consistent assignment. For image and description best practices, focus on both internal efficiency and customer-facing clarity. For internal efficiency, use consistent product descriptions, starting with the most important identifiers. For example, use desk chair, ergonomic, black, mesh back, rather than black mesh office chair with lumbar support. This makes finding products during transaction entry much faster. Include key specifications in the description field, not just in custom fields, as the description appears in search results. For customer-facing documents, add product images by editing the item and clicking the image icon. Make sure you use high-quality, consistently styled images with clean backgrounds. Focus on benefits and specifications customers care about, and keep internal SKUs and codes in separate fields. Consider integration with e-commerce or point-of-sale systems, and aim for consistency across all customer touchpoints. Common mistakes and how to fix them. Let's address common mistakes in item setup that cause reporting errors. Inconsistent income account assignment is a frequent issue. When similar products or services are mapped to different income accounts, for example, some consulting services to professional services income and others to consulting revenue, it splits revenue reporting and understates each category. To prevent this, create a clear income account structure before setting up your products. Use accounts that match how you want to analyze revenue, and use parent-child relationships for detailed breakdowns. Reference existing similar items when creating new ones. Periodically review your products and service list, sorting by income account, and correct any inconsistencies promptly using batch update tools. Consistent mapping is fundamental to accurate revenue analysis. Improper cost account mapping is another common problem. 3 typical mistakes are mapping inventory items to expense accounts instead of to the COGS account, using inconsistent COGS accounts for similar products, and failing to separate direct product costs from operational expenses. To correct all of these, review your chart of accounts for appropriate COGS accounts aligned with your income accounts. Verify each inventory item's cost account mapping through products and services, edit item, cost of goods sold account. Ensure direct product costs appear in COGS accounts and indirect costs in expense accounts. Proper mapping allows accurate gross margin calculation by product line, which is essential for pricing and product strategy decisions. Inventory tracking errors significantly affect your balance sheet. These come in 3 types: quantity errors from missed or duplicate transactions, valuation errors from incorrect item costs or adjustments, and classification errors from improper inventory versus non-inventory settings. These errors misstate your balance sheet, affect asset valuation and COGS, and can create tax compliance issues. To correct them, perform regular inventory counts and reconcile with QuickBooks records. Use the Adjust Quantity Value on Hand feature when needed. Review your inventory valuation summary monthly, looking for unusual changes in quantity or value. Verify positive quantities and reasonable values, and trace systemic errors to source transactions. Establish regular verification procedures and consult your accountant for significant corrections. Product and service setup can break tax calculation when items are incorrectly marked as taxable or non-taxable. When items aren't assigned to the correct tax category for multi-rate jurisdictions, or when similar items have inconsistent tax settings. To fix these issues, verify company-wide tax settings through the gear icon, Accountant Settings, Sales Tax tab. Review each product or service by checking the Products and Services list, Sales Tax column. Edit items to update the Is Taxable checkbox as needed. For multiple jurisdictions, use the tax code assignment feature and create consistent procedures for new item setup that include tax verification. Run products and services reports filtered by tax status to identify inconsistencies. Proper setup prevents billing errors and reduces compliance risk. Remember, if you are tracking your inventory in your point of sale system, all of this setup in QuickBooks may not be necessary. Make sure you check with your accountant for direction. What is your biggest challenge when setting up or managing products and services in QuickBooks Online? Have you found any creative solutions to product setup issues? Share your experiences in the comments below. I'd love to hear from you. Thanks for watching this 4-part series on QuickBooks Online setup and management. If you found this helpful, please like, subscribe, and share with others who might benefit as well. Visit bookkeepingcoach.net for more resources to transform those financial headaches into financial clarity.